Hey everyone, welcome to the final bar. My guest today, JC Parets from All-Star Charts, joining us, going to talk about some of the constructive patterns that we're seeing. We talk about the improvement in breadth. Today, we're seeing the S&P continuing to push higher, really breaking out of that 3,200 to 3,400 range, and now following through and breaking above the swing highs from mid-September. I think this clears the way to S&P 3,600 and maybe higher. We're going to look at the charts and see what the long-term trends tell us. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at the markets through the lenses of technical analysis, behavioral finance, investor psychology, quantitative methods, anything we can bring to bear to try to make sense of a volatile, uncertain environment. As I mentioned in the introduction, we've been seeing this rotation, I think, in the last couple of weeks from, deterioration where you saw the potential for further downside. You saw support levels being tested. You saw areas where you would start to draw a line in the sand and think about the potential for much deeper downturn. Since then, though, I think the breadth picture has improved. You're seeing constructive patterns in the form of new highs. You're seeing the cumulative advanced decline lines start to go from going down to going up. And you're starting to see some meaningful breakouts across the board. And so I think, at some point you have to recognize that the long-term trend has remained pretty positive, which I think it has. As I mentioned a number of times, we talked about that S&P 3430 or so level, which are the recent swing highs. If and when we broke above that, I tell you S&P 3600. I think we've seen it. So that's where certainly I'm looking here. And we'll talk as we get to the market recap about some of the key levels to pay attention to. Just as a reminder, coming up on today's show, we have JC Parets joining us shortly from All-Star Charts. Coming up next week, we have a couple of really good guests for you. On Tuesday, October 13th, we have Jeff Weiss from Clearview Trading Advisors. Jeff was one of my early mentors as I was just getting started with the CMT program and taught me a lot about long-term charts and how to pay attention to them. On Wednesday, the 14th, we have Mark Newton joining us from Newton Advisors in New York. Also, just a heads up, for the first time, we'll let you know on October 19th, we are going to be doing a presidential cycle panel. The 4-year cycle or the presidential cycle is a pattern that many strategists have talked about for many, many years. We're going to have guys like Tom McClellan and Jeff Hirsch and others sharing with us how they incorporate the presidential cycle, what it's telling us about the cyclical patterns, the seasonal trends in an election year, and what this means going forward through year end and into next year. So it should be a really cool event. I'm excited to moderate that event on StockCharts TV. Let's get to our market recap. So looking at a daily chart of the S&P 500, and then we'll get to some of the other movements, the other asset classes. This is the daily chart we've been working with for a while now. And, again, I think my impressions and my voice certainly got the most dire right around here, which was we had come off, and as we came off of the peak just below 3,600, my first thing I start looking at is this blue shaded area, which was the peak from early June. That became another sort of level of resistance here in mid-July. We then broke out and retested it from above here in late July, and then we went and broke to new swing highs. That cleared the way to retest the previous highs and on from there. As we sold off, that was probably the most meaningful key support level after we broke that first tactical support just below 3,400. And so what has happened is we have now found support where you would naturally expect it. The RSI bottomed out just around 40, which is where you'd expect it in a bullish phase. We then broke above trendline resistance. We then broke back above the 50-day moving average. And now I think we've completed that rotation above this previous resistance from early to mid-September. That's the first reaction high or the first swing high after the pullback off of the all-time highs there the first week in September. So at this point, as we've talked about for the last couple of weeks, if we get above those levels, if we follow through, complete this rotation, I'll be the first to tell you S&P 3600 on the show, and I think we're there. I think you have to assume upside rather than downside. I think the breadth has become more constructive. As always, I'm a cautious bull, just like I would be a cautious bear, looking for signs of reversals. And I think I'll be the first to tell you when we start to deteriorate from here. In terms of what could go wrong, right? What would invalidate that bullish thesis to 3,600 plus? For me, it's, we're looking at it. I think the first line in the sand would be still this level, this range around 3,350 to 3,400. That includes the 50-day moving average. If we would break that on a pullback, and now we have this swing low around 33.25 to 33.30, that would be the signal that this is incorrect and that we're going to retest some swing lows. The ultimate line in the sand remains this blue shaded area, as we've talked about. And as we've said, as long as we remain above there, overall things on the long term are still fine. It's all about that tactical short-term trend. And if we had enough follow through to the downside, I think that's alleviated now. And the patterns that I'm seeing and the breakouts I'm seeing on individual stocks are what give me probably the most encouragement rather than anything else. Let's look at some of the other movements and what we're seeing here, and then we'll continue on. So the S&P actually finished 0.8% higher today, finishing around 3446. Mid caps and small caps even further. So that performance of small caps is a phenomenon we've talked about. I wrote an article in the last week or two talking about the IWM relative to the S&P 500 and a rotation of that ratio back above its 200-day for the first time in a couple years. I think October of 18 was the last time that really had happened. So certainly an outperformance from small caps continuing on a day like today. The NASDAQ 100 actually lagging behind. And again, as always, I'm looking for question marks on a thesis. And the fact that technology underperformed is notable. The fact that consumer discretionary underperformed the S&P, that's all kind of interesting. This was led by energy, utilities, and real estate. So, it is not the 100% all, step on the accelerator, everything working, but enough working that the S&P's going higher. And I think that's what's the most important takeaway for sure. Bonds actually were stronger today as well. So both stocks and bonds did better, with 10-year yields coming down around 76 basis points. Oil stronger, and that's obviously one of the real reason why energy finished up. But across the commodity space, overall, for the most part, pretty positive, with gold and silver both up under 0.5%, but finishing stronger. Gold had chopped around a bit. So it was one of those things where almost everything finished on the upside. The dollar was essentially flat. That's the only real outlier to that overall positive thesis. As I mentioned, in terms of sectors, things to note, energy being pretty positive today. This is obviously coming out of pretty depressed levels. So, financials and energy outperforming on a day like today is interesting, with something like financials or energy sustained moves of this sort of thing where an uptrend continues to be supported by further highs, right? One day does not make the trend, but a succession of those sorts of things is what makes the trend for us. We're going to talk about a couple other charts here, and then we're going to take a commercial break. What I wanted to do, though, very quickly was talk about a candle pattern. A number of people highlighted, and we certainly focus on this as well, the bearish engulfing pattern. If you look at the financial ETF, this is the XLF, and if you look back here in early September, you have what's called a bearish engulfing pattern. This is where, in an uptrend, you have an up bar, an up candle, right? An open candle, meaning we close above the open, pretty broad day, and then a higher open, a lower close on day two. And the second day's real body open to close engulfs the previous day's body. That's why it's called a bearish engulfing pattern. That's a short-term negative pattern. If you can see here, as usual, when it happens right at the 200-day moving average, you get a bit of a pullback, and that lines up with sort of the traditional use of that candle pattern. You had a very similar read here a couple days ago when you had the rally out of the swing lows. You had a bearish engulfing pattern, up day, down day, and the fact that that looks so similar to the pattern we saw in September certainly made me feel pretty confident we're going to get a bit of a short-term sell-off. Didn't happen. And what's happened since then is that pattern has been invalidated. What Steve Nissen told me years ago as I was talking with him about candle patterns was, a lot of people oversimplify and they just look for a pattern and assume that's it. But, his big takeaway was using the range of that pattern. So using the high and the low of that day two as part of your analysis. And so once we break down through the lower end of that pattern, that's what validates the bearish engulfing pattern. If we don't, which is what's happened, we've actually gone above this high, that actually invalidates it. It says, you know what, that wasn't a bearish engulfing pattern. It never was validated, and it's suggesting further upside. So now on something like the XLF, you're breaking back above the 200-day moving average. You have bearish candle patterns that aren't following through, and that certainly speaks to the inherent strength of what we're seeing. On things like financials, and the XLF is a great example, you now have a pretty clear area of resistance. If you take the highs in June, you can take the peak here and here. All of those happen at the 200-day moving average, totally valid. But now I think you need to get above this level just below, around 25.50 or so. If we can get above there, that's what really validates the upside. But until then, I'm rather, I'm much more excited looking at groups and stocks and sectors that are able to break out effectively. And we're going to hear, I think, from JC, one example, one area of the market where we've certainly seen a breakout. We've certainly seen some of the follow through. I did want to point out, obviously, looking at some of the group themes, 4 of the top 10 industry groups today based in the energy space, with oil, equipment, and services number 1. And then again, 3 of the other top 5 in the top. You also have home construction, which is home builders and everything, making a new 52-week closing high today. So plenty of movements in there. And again, an environment like this where things start to feel more constructive, the places I would look are where relative strength is improving, where they're able to get above, not just test resistance, but break out of resistance, break out of bases. And that's where I think some of the opportunities are going to continue to lie. We need to take a quick commercial break. Back with my guest, JC Parets. We'll see you in a minute. Hello, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we love to hear from you, feedback on the show, feedback on your hosts, but especially questions that you're running into as you go through this discovery process of learning, charting, technical analysis, trying to answer the questions in your mind as you look at the market. So you can get questions to us a couple ways. The Final Bar at StockCharts.com is our email. On Twitter at FinalBarSCTV, or on YouTube, just put a comment below the video you're watching. We'll capture all of those. We'll have another mailbag segment on Friday's show, and we'd love to answer one of your questions on the air. I want to welcome on my guest back to the show, JC Parets from All-Star Charts, giving us hopefully a good perspective on how to deal with a market that appears to be continued constructive. JC, welcome back to the show.
Thanks for having me, Dave.
So you sent a couple charts ahead of time, which I very much appreciate. The first one, you and I were talking before we started the show just about, breakouts, and in particular looking at transport. Start us here. What is your macro take on what we're seeing here?
Dave, I mean, how many markets have you and I looked at over the years? And correct me if I'm wrong, but breakouts to new all-time highs coming out of 33-month bases. I mean, if you're going to be shorting those, I don't think you're going to be successful over the long run. I think when you see breakouts to new all-time highs coming out of what's close to a 3-year base, gotta buy those, right?
Decent breakout, and I remember being taught something related to that at some point along the way, JC, yeah.
And then just think about the implications of what that means. Okay, fine, great, buy transportation stocks, fine. But think about the more global implications when you talk about Dow theory, when you talk about how Dow transports are breaking out to all-time highs. Papa Dow, the Dow 30, can't be too far behind. And if the industrials are making new highs, transports are making new highs, and we're getting rotation. Remember, it wasn't too long ago that the transportation stocks were the laggards, and now they're breaking out to new highs before the industrials.
It's totally right, and it's very much a flip. And I think you hit on a point that I would be looking for, and I know others, right? You get the breakout in transports. That is absolutely right. You get a breakout in the Dow Industrials. You would be deserving. It would be a disservice to yourself and your investments if you weren't following that sort of.
By the way, Dave, I think it already did it. I think the industrials already broke out. I think we had a whipsaw at the beginning of the year. I think the real resistance was those 2018 highs in the Dow Industrials. So I think we've already broken out.
Fair enough. Now, when we think about sort of that next level below the hood, given that environment, given a constructive pattern, the question always is, where do you look now, right? Where are the opportunities? You have a great illustration of what we're seeing in consumer discretionary. Talk us through this visualization, if you could.
Yeah, you just touched on relative strength before you and I started talking, and I mean, you nailed it. So this is a really interesting chart. So this goes through the end of September. So this is about a week old, but still makes the point. So on the y-axis, on the left side of the chart, you have the third quarter return. So in other words, the higher up the bubble is, we're looking at all of these sectors in the United States on an equal weighted basis, on a cap weighted basis, the small caps and the mid caps. This goes for all the sectors in America, right?
Right.
The further it is up on the chart, the better it did in the third quarter. And the further to the right, in other words, the y-axis, is the performance off the March lows. So the best ones are the ones in the upper right. The worst ones are the ones in the lower left, is basically the deal. And what do you see in the upper right? Mid-cap consumer discretionary up 124% since March. Small cap consumer discretionary right behind it. Cap-weighted discretionary, which is a whole bunch of Amazon, but then more importantly, the equally weighted consumer discretionary, which takes out the Amazon effect. So that, to me, stands out the most, followed right behind by materials and industrials, and of course, the large cap tech can't be too far behind, right?
It's interesting. So up here to the upper right, these are things that really have gained the most from the March market low, but also had a strong third quarter, right? And so they're really showing resilience across the board. And it's interesting to see some of the, I'm immediately looking to the other end of the spectrum, and you're seeing financials, real estate, some of the mid-cap, smaller parts of those sectors too.
Gross. Like if you have a weak stomach, like don't look to the lower left,
Never confuse the bottom of the page with support is a phrase you and I have passed around occasionally.
That's right. And the top of the page with resistance.
That's
right?
Exactly right. And with that in mind, we have the third chart, which is Peloton. What are you seeing here?
Well, I mean, I just couldn't help myself. I mean, obviously it's on an uptrend. It's been one of the biggest winners for us and a lot of people. This isn't like a secret, but I just want to point to, well, first of all, it's part of the consumer discretionary story. So it kind of fits with the conversation we're having in discretionary. But I want to point out that it was making all-time highs in the spring, right? So this was very quick to take out last year's highs. That's relative strength. And then what did it do in May and June? It consolidated that breakout. And then at the end of June, broke out again. And then consolidated that breakout throughout July and August. And then what did it do at the end of August? It broke out again. Consolidated, it broke out again. That's the stair step. That's what we call uptrends, right? This is as classic as it gets. Positive momentum, relative strength, higher highs, higher lows, the right sector. Folks, this is technical analysis. This is why technical analysis works, because we are looking for trends. That's it. We're trying to identify trends. And this one goes from the lower left to the upper right, Dave.
JC, Charles Dow, I'm sure would be very proud. You're talking Dow theory. You're showing a Dow uptrend of higher highs and higher lows, and certainly plenty of evidence suggesting further upside. JC Parets, All-Star Charts, thanks so much for coming back on the show, my friend.
You got it, Dave.
That's JC Parets from All-Star Charts, coming to us from Eastern Pennsylvania. Some really good, and again, some takeaways that what I love talking about with JC. Anytime we've had conversations, our toolkits, our way of thinking is very much in line because it's based on following price. When price works, you lean into it. Where price does not work, you lean away from it. And if I've ever disagreed with JC, it's debating where the trends are leaning or not. But you can't argue with some pretty clear charts showing some potential upside. It's a great take. Our next segment is called Compare and Contrast. This is a relatively new one. And one of the things I was talking with my producer about was, just looking at different ways we can compare some of the visuals and break down the analytical process of comparing chart A to chart B. So often I find as an analyst or as a trader, as an investor, you focus on the chart, you put the blinders on, you focus on a particular trade. But I think especially for individual investors, for financial advisors, and often for institutional managers, the question isn't how to analyze this particular chart, right? If you're looking at Procter & Gamble or Caterpillar or Peloton or whatever, The question is, it's relatively easy to learn the toolkit and to analyze the price effectively. What is not easy is to find those ideas, or we make it a lot more complicated than it needs to be. The real trick is differentiating in an up market, in a down market, anything in between, what's working and what isn't, how you can compare and relate different things together. So what we're going to do is walk through an analytical comparison of two different stocks in a segment called Compare and Contrast. So what I'm doing is, these are two charts we've talked about on the show this week. Procter & Gamble, we talked about as one of our 3 and 3 charts 2 days ago. Caterpillar is one of our 3 and 3 charts yesterday. Both of these overall have been relatively constructive. And what I wanted to do was just compare and contrast these two charts. How would you look at them relative to one another? We're using the gallery view for this. And if you're not familiar with this part of StockCharts, at the very top, there's a little drop down. It usually says Sharp Chart. This is where you type a ticker and you get the chart. If you click on that drop down, there are a lot of really cool things you can do, like the simple summary, which tells you when a company is reporting earnings, some basic valuation data, fundamental information, et cetera, et cetera. We're going to go down here to gallery view. And when you switch that, you can enter one ticker and you get a gallery view of intraday, daily, weekly, and point and figure charts for that particular stock. Or you can separate two different tickers by a comma and you get to compare them like we're doing right now. It's a great way to compare stock A to stock B, ETF number 1 to ETF number 2, and draw some comparisons. We'll skip the intraday view only, and actually, no, I won't. Sorry, I said that, but what I wanted to show here, both of these obviously have had a good stretch here. They both started to break out. They both showed some constructive patterns in the short term. The reason why I think we start here is just to remind everyone, we're going to get to the longer term picture here in a second, but I find a lot of times, especially when you're looking at a particular stock today, if you're looking at just today's trading, it's hard to put that into proper context. I usually look at a 5-day chart if I'm looking at intraday data, because it shows you today's trading, where both of these stocks really finished near the highs of the day, which is an impressive move today. But what's more important to me is how today's move fits into the big picture. What are the previous 4 days? What's the last trading week look like? And how does today fit into that big picture? And you can see that these are all following through after constructive patterns for the last 5 days. That's all I wanted to show there. Looking at the daily charts as a second read, this is where we can start to see why these charts both popped up on some of my screens. The screens that I run often are looking at stocks making new swing highs and swing lows. One of the most common screens I run all the time are stocks making new 13-week highs and making new 13-week lows. I run that on ETFs as well. And while that's not on its own, that is not the only thing you should or could look at, but it definitely gives you a list of charts to start to dig through. What are the characteristics of those charts? What do the trends look like? And what analysis can you make relative to those patterns? Now, as we're looking at both of these charts, you can see they're both making new 52-week closing highs. Today, they both look like they've made new intraday highs today as well. So they're certainly both in the upper right corner, which overall is good if you want to buy strength. These have certainly demonstrated it. Both are above two upward sloping moving averages, the 50-day and the 200-day. That's constructive on both sides of them. If you look at the RSI and you look at the relative strength, you're going to find some little differences. So while they're both at new highs, the RSI picture has looked a little different. You can see with Procter & Gamble, it became overbought here in late July, while Caterpillar was a little earlier on. Still both moving higher, but you can see that this actually became extremely overbought. And what that means is when it broke to new highs here in late July, it accelerated to the upside. So while Caterpillar was more of a slow and steady gainer, Procter & Gamble sort of went vertical to a little degree. That caused an extreme overbought condition. And what that means is the uptrend, usually means the uptrend is so strong, you'd expect a bit of a pause in that trend when it comes out of the overbought condition, which we saw. But overall, the uptrend has been so strong, you'd expect at least one more leg higher. And I think we're in that scenario right now where you're seeing further strength coming out of that extreme overbought condition. So overall, the RSI has looked a little different, really speaking to the acceleration of Procter & Gamble in July into August, but overall, now both in a similar pattern, not yet overbought on either side, which is encouraging. That tells you that there's certainly room for further upside in both cases. The relative strength picture, a little different as well, and I've often talked about relative strength. I would encourage you, if you don't have this series, looking at the ratio of the stock versus a benchmark, I would encourage you to put it on there, because especially when stocks are in constructive patterns, it's easily to make them all look very homogeneous, because when we look at price, we naturally stretch the price out to fit the vertical space that you have on the chart. That's sort of the convention. Relative strength is what allows you to compare two things on an apples-to-apples basis. We can now see over the last 12 months, Procter & Gamble has underperformed the S&P by 1%. Caterpillar, on the other hand, has outperformed by almost 13%. So while the patterns look different, while the price patterns look different, you can see that Caterpillar's actually done very well. Now, a lot of that probably came from this initial move. If you look at the beginning, if you start the clock in October, you can see how Caterpillar started in a position of strength. That's where a lot of the gains came, whereas Procter & Gamble was sort of flat in line with the S&P, and that's why it's a little different read. The trend in relative strength for both of them has been constructive, and I think that's what's most important to take away here. Finally, we're looking at the weekly chart, and this is where these things, it's a little more of a contrasting view than what we've seen earlier. When we look at the last 5 years, you can see that Procter & Gamble has been going higher on an absolute basis for the last couple years. You can see that it really broke out of resistance from 2017 and continued higher, and with the pullback to the March 2020 lows, it recovered that, broke to new highs, and now we're pretty far above the February 2020 high. Compare that to what you see with Caterpillar, where the all-time high was back here in 2018. So while Procter & Gamble is at a new all-time high this week, Caterpillar is not there yet. It's nearing that all-time high. And I should make the note, this is using adjusted price data. So if you put a little underscore ahead of Caterpillar, you look at the actual traded price back on these dates, and the all-time high was actually a little bit higher, around 170 if I remember right. So if you're looking at the actual price high, I would put an underscore before the ticker. That gives you a little better read on the actual price data. But using adjusted data, which is the convention to adjust for cash dividends and splits and such, you can see that we're nearing that all-time, not all-time high, but we haven't made it. So you have a stock that has made all-time highs and a stock that has not quite done it yet. Having said that, I think the relationship between the two is what's most telling, and the fact that, in terms of the similarities, stocks making new highs, stocks breaking out from the top of the page, continuing to be above upward sloping moving averages are what are most impressive on both of those charts. That's why we highlighted them, and that's why I pay attention to them going forward. That is our segment, Compare and Contrast. I hope that's a helpful look at how you can analyze two charts side by side and draw some meaningful conclusions. We need to wrap the show and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is using our traditional Dow theory, looking at the Dow Industrials and the Dow Transports. JC Parets earlier on the show did a great job of pointing out the strength that you've seen in the Dow Transports. That is undeniable. For me, I got a little skeptical here about potential for further upside when I saw the Dow Industrials breaking to new swing lows while the transports held up. That has now been alleviated because the transports have now gone to a new 52-week high. The Dow Industrials have not quite done it. I disagree a little bit with JC on his take, but he is absolutely right in seeing the potential for upside. For me, I would love to see the Dow Industrials break to new 52-week high to confirm that Dow theory uptrend. But overall, absolutely right, constructive now more than it has been in quite a while. Chart number 2 is the small cap index. $SML. We talk about the IWM a lot. That's the Russell 2000 ETF. But what I'm showing you here is the S&P 600, which is a smaller basket of stocks, but still a pretty good cross-section of small caps. For me, the fact that we've tested resistance here on the small cap index in June, tested it again in August, we're right back up at those levels. I would love to see the small cap index break to new swing highs, break above that June high. That would tell me that there's certainly much more room in the tank or gas in the tank to go further to the upside. We've seen the relative performance of small caps start to improve in a way that we've not seen in a little bit, and even more exaggerated, I think, with the IWM. I'd love to see the small cap index break above that level to confirm potential for further upside. Third is my chart of Intel, INTL, highlighting charts making new swing highs. This one's a little earlier on. So Intel gapped down here in July. This is an outlier relative to other stocks in the semiconductor space that have held up very, very well. What's interesting now is you have a pattern of higher lows and now higher highs because it just broke above the peak from September. It had retested that at the end of last month, pulled back, and then broke to new swing highs. And I like the rotation to a new swing high. The 200-day moving average, the next logical upside, but I think there's room to 56.37, if not much further to the upside, retesting some of these previous highs. And this is in a space, semiconductors, and on a relative basis has held up very, very well. Folks, that is our show for today. A special thank you to JC Parets from All Star Charts coming on the show, sharing a very constructive and valid view of potential upside. Get your questions to us for our final bar mailbag segment at the end of the week. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.